In today's competitive real estate market, modern buyers strictly filter their listings, searching only for homes that are entirely move-in ready. When a property shows visible deferred maintenance, like chipped paint, damaged siding, or outdated carpets, the majority of the potential buyer pool simply moves on to the next listing. Sellers use make-ready renovations as a defensive strategy to protect their equity and attract competitive offers. This comparison shows the impact. An as-is sale often forces steep concessions and more days on market, while an optimized path targets the highest possible valuation from day one. Preparing a home for market requires technical management of capital allocation, vendor schedules, and material procurement. For the property on Montgomery Drive, the objective is to hit a top-of-market valuation of $210,000. The owners want to secure that top-tier price, but they require a solution that doesn't involve sourcing their own materials or managing contractors daily. Reaching the $210,000 target requires a $22,000 upfront investment. This waterfall chart starts at the baseline unrenovated value. We add the $22,000 for physical upgrades. Finally, subtracting closing costs and taxes reveals a projected net closing check of $209,000. This $22,000 is a defensive allocation. It secures the home's appraisal and prevents the asset from losing value during an unnecessarily long listing period. One route involves hiring an independent consultant who manages both the physical renovation and the eventual real estate listing. The advantage is that local market data dictates the renovation scope. The work is limited strictly to the specific upgrades that historical sales prove will increase the final price. This data-driven approach prevents the owner from spending money on structural changes that don't yield a return in this specific neighborhood. The risk is the concentration of power. One individual holds total operational control over the project budget and the sales strategy. Success with an independent agent depends on a rigorous vetting of their construction oversight history and their previous project timelines. Sellers must choose between a local independent manager and a national commercial firm. This matrix evaluates the trade-offs of both models. Independent managers typically operate with lower overhead and higher agility, adapting quickly to changes on the job site. Local managers also have the flexibility to negotiate specific concessions with their personal network of subcontractors that larger firms often cannot match. In this case, the manager secured a 10% senior citizen discount on labor, which saved the client nearly $700. Large commercial firms offer their own advantage. They maintain massive in-house teams for immediate deployment. While independent managers save on costs, their ability to hit a 30-day deadline relies on their personal standing with local tradespeople. A successful make-ready requires a highly disciplined focus on specific physical improvements. This scope targets visible, high-impact items, installing luxury vinyl flooring, refreshing the interior and exterior paint, and repairing damaged screens. This work prioritizes builder-grade durability. Every selection aims for universal appeal to ensure the property survives the scrutiny of a buyer's inspector. Because the manager uses vetted third-party local vendors, standard contractor warranties apply to both the physical labor and the materials. Keeping the project strictly cosmetic ensures the home presents as a turnkey asset without the risks of overcapitalizing on major structural changes. Paying for a $22,000 project requires a structured approach to cash flow, rather than releasing all the funds at once. This timeline shows the milestone-based draw schedule used to fund the operation in stages. An initial draw of approximately $11,700 covers all materials and the first third of the labor. Subsequent payments are released only after midway progress is verified and final physical completion is signed off. The project management fee is a separate line item of roughly $4,400, paid only after the physical work is finished. This system requires liquid capital up front, unlike corporate programs that defer all costs until the home closes in escrow. That management fee is the cost of bypassing the operational burden of sourcing vendors, purchasing materials, and supervising daily job site quality. Determining if a managed renovation is the right path depends on your personal resources and timeline. This matrix evaluates the fee against your situation. It's ideal for full-time workers unable to oversee sites and provides a trusted framework for senior right-sizers handling legacy planning. We rule this out for DIYers with the time and experience to manage their own projects. Those sellers are better served by acting as their own project manager and keeping the fee in their own pocket. Hiring a manager costs a fee, but the alternative, bungling a renovation or letting a property sit for months, is significantly more expensive.